things that came out this week, which was really good news, is that U.S. initial job claims fell again.
Right. They fell for the second week in a row, which, again, is illustrative of a notably improving labor market, declining 39,000 week over week to 547,000. And we're hearing increasingly that people are having a difficult time finding workers, that workers are either nervous about going back to work in the context of the virus or they're content receiving unemployment benefits until they run out in September. But the labor market is clearly improving, and the Fed has basically signaled that would continue to happen.
Right. And I will tell you, it happened at least a half a dozen times this week. Business owner clients of ours said they cannot get people to stack the shelves, to move the stuff, to landscape, right down, even skilled labor, moving right up. They can't find the labor. And so they're starting to turn down business. That's just unbelievable to tell a small business owner to turn down business because he can't find help. But there certainly is what is happening. And the other thing that came out this week was in the real estate market. There was some evidence there as well.
Yeah, we've seen strength in the real estate market. New home sales were over 1 million units in March, much better than expected. Inventories still remain low. Redfin actually suggested that last month a record 43% of homes that were sold went above their listing price, while active listings fell to new all-time lows. So strength in home builders, strength in the lumber market, all the rest. The housing market's an important component because it leads to so many other purchases like appliances, landscaping, furniture, deck repair, all the rest. So a very strong economic backdrop right now.
Whirlpool reported last week, right? They did pretty well.
Yeah, and that's just some more evidence that, if we talk to people who have purchased either second homes or other places, and they say, they're paying up for the furniture that's in the house. So if you're hearing this and you're selling your house, your furniture has value. But there's no question that housing and the related industries, as Derek just pointed out, have been doing well. And of course, infrastructure, everyone is talking about. We may not get to $2 trillion, but there is certainly a starting point of 800 billion. It's somewhere between there as we're going to see infrastructure where there's related industries there as well.
Yeah, I saw an amazing chart that came from Brookings, and it basically showed that spending on repairs and maintenance on infrastructure has continued to go up over the last 20 years while investment has gone down. And we're kind of at a point as a country like old cars. There's a point where it makes more sense to buy a new one than to continue to keep that old jalopy running.
Right. And so, there's no question we're seeing car sales go as well. So those are all good news. And then lastly, we saw some financial reports come out. The earnings, we're now in earnings season. We expect a really good earnings season. Banks did pretty well, Derek.
The banks were the first to report. They, for the most part, reported better than expected results. They had clearly over-reserved during the pandemic as companies did better and default rates were much lower than they had thought initially. So that's a plus. In addition, the banks are now going to be allowed to raise their dividends and do corporate buybacks if they so choose. And with corporations holding over $2 trillion in cash, it's not hard to imagine buyback activity picking up, which would certainly be a pillar for some sectors of the economy.
And it's good, but however, it also received a ton of bad press about a year ago when they said, listen, you were buying all your stocks back and you didn't reserve enough. And they said to some financial institutions, you couldn't do that any longer. So you have to be really prudent going forward in these boardrooms if they're going to continue to do that. We think they are. Lastly, about the financial stocks is Archegos, which was this hedge fund, really family office, blew up and cost some major institutions, Morgan Stanley being one of them, and Credit Suisse. We don't think we've seen the end of that story.
No, I mean, with the new SEC chairman in place, he has a lot of experience from working in a prior administration. You'd expect them to take a look at that and to understand why a large client like that could have multiple prime broker relationships that had limited transparency, because how, as a prime broker, do you assess the risk if you don't know what their overall holdings are? A second element, too, is what we saw with the SPACs, Special Purpose Acquisition Corporations. A lot of people have lost a lot of money in those, and I frankly have been surprised it hasn't happened sooner. But many of these sponsors are actually selling the stock prematurely. They have no lockups, and that's really to the detriment of investors. So the SEC has some work to do.